Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in there, take a look, and see what people are sharing. If you want to follow me at Finance, and if you want to join our community, finding-value.com, we do have a question and answer session occurring today from 7 a.m. Mountain Time on to 10 or 11 a.m. Mountain Time. So coming on down, Captain Foresight, he says crude continues to track along the low of the 5-year inventory cloud. So from a fundamental perspective, this is U.S. crude oil stocks in terms of inventory is towards the 5-year range on the low end of it. So it's not like we have a bunch of inventory and we're adding to inventory. We're still drawing down and we're still towards the low end of it. The question then becomes, does the sector fundamentals overweigh the large macro environment of a potential recession in a yield curve on inverting? That's the big question. I think that's why some of the oil stocks have been trading sideways for a good chunk of time. That includes also energy service has been up and down depending on the energy service companies that you're looking at. Some are held down, and some have been trending higher over time. But that's where we're at with U.S. crude oil inventories. Here's GDXJ. It says a move above $50 could trigger a significant rally as the stock approaches the right edge of a rounding bottom pattern, a bullish formation that suggests a shift from a downtrend to an uptrend. The presence of a monthly dragonfly doji candle here in August indicates a retest of the breakout above the key resistance line, which coincides with the corner of the rounding dome. This doji, characterized by a long lower wick, suggests that although sellers tried to push the price down, buyers stepped in strongly to regain control, keeping the close near the high of the month. The price can break above $50 level. It could signal confirmation of the rounding bottom and fly much higher, according to this guy. What I see, yes, it's just up against some resistance. Now, what I do is I look deeper than just GDXJ or GDX. What drives GDXJ higher? And that's the engineering side of my brain. It's not about getting a technical chart that just looks good. What I want to know is, why is GDXJ or GDX or any of these gold mining companies, why are they going higher? What is driving this move higher? In my opinion, it is the market conditions. And the market conditions that these go up under is when gold starts to outperform the consumer price index, aka that is your margins for the mining companies. So this all looks very good. It's a good setup. And behind it, that drives this, also looks really good, which is a gold to CPI ratio that's about to break a very large pattern to the upside. And if we get that breakout, I'm sure that this will work its way on up, probably quite dramatically. Marty Party says there is 6.4 trillion cash sitting in money market accounts earning 5%. That changes on the 18th of September. The rates drop, money moves back to assets. Are you ready? That very well could be the case. As rates go up, people speculate less because they can earn more money from the quote risk-free rate return from bonds. As bond rates go down, people have to speculate more to get a higher return. So he is right, and that is correct. The big question is, why are rates dropping? Why is Powell dropping interest rates? Is it because of weakness? Is it because of the debt, the interest payments on the debt that the government has to pay? Or is it a political drop where they're trying to increase the stock market? I don't know if anyone knows that answer outside of the small group that Powell hangs with. But yeah, that's really the question there. A lot of the times when interest rates have dropped, it's been because of weakness that the Federal Reserve has seen in the markets. And then it generally is basically concluded with a sell-off in the market, is what history has shown us most of the time. A4 Alpha says TMF, do not be fooled by OPEC intentions. Akin to the Fed, OPEC will win. The groundwork for cutting production will not go in vain. Trust them. They will make the right moves and buy on red with confidence. Many balance sheets in Canada have not looked stronger, and thank you. So that is true. We've got this kind of this is a very difficult market to read here. This is the reasons why. They've got a lowering of interest rates, which generally comes from a weakening in the market. But then you've got OPEC, which is about to increase production out in October. And it's like, well, they wouldn't cut into weakness. They would continue to produce more if the demand was there for it. So if the demand is there for it and they're going to increase production, well, what about the decline of interest rates and the uninversion of the yield curve? Yeah, that's where it gets real interesting. So we're at the crossroads where we've got mixed leading indicators, mixed signals when you look at this compared to history. And that's where sometimes you take the wait and see approach and you wait for breakouts or breakdowns to occur. And that's kind of what I'm doing. I'm kind of waiting and watching. There's a lot of information that's being digested by the markets across the board here. And with OPEC, basically with OPEC increasing production out in October, it makes me think that the markets are actually stronger and that the rate cut may not matter as much as I thought. And then we've got a lot of fiscal spending going on here, guys. There's a ton of fiscal spending. So we've got a lot of data kind of overlapping each other here. So we'll see how it kind of plays out over the next month or two. Quote of the day: what we learn from history is that people don't learn from history, says Warren Buffett. Yeah, a lot of people, I don't know if it would be repeating the same mistakes, but they are making the same mistakes as people in history. But if you don't know that people made those same mistakes in history, then I don't know. You can't say it's being repeated. You just got to say that they're making the mistake themselves for the first time that other people have made in history. Lynn Alden says they're running 7% structural deficits and you're bearish, question mark. That's the inflation and the fiscal deficit that's going on here. So 7% structural deficits this is what's driving it. That's what's driving a lot of this inflation and driving the economy, we'll say. So she thinks, her opinion, that the fiscal side is more important than the monetary side at this time, and I agree with that. It is. And if they lower rates, we'll see if the monetary side kicks back into gear or not. Peter Schiff says, the dollar is up and gold is down, as traders feel today's inflation data may put future rate cuts in jeopardy. Regardless of how bad the inflation data gets, the Fed will not alter its plans to cut rates. The cuts are not about inflation, but about delaying a financial crisis. So in his opinion, the driver is a financial crisis and inflation has less to do with it. That's also what the Fed has said themselves. They said that the jobs number is a bigger deal than inflation. So I would agree with his opinion. Here's Eric Nuttall. He says, the U.S. shale production has been flat for the past 8 months. Yet, any day oil is down, we hear of record high or surging U.S. production. I don't get it. The era of U.S. shale hypergrowth is over, and OPEC is in the driver's seat going forward. And this is that sideways production going on in shale oil. Home buying conditions have never been worse. This is the University of Michigan home buying conditions record low. I see this back in the late 80s. My question is, does this even matter? Would I buy a house if I didn't own a house today? Um, if I was in a certain location and let's say rent was somewhat similar to buying, I would buy a house. I don't care what the buying conditions necessarily are of some survey. If I would benefit from buying the house and if I lived there for a long period of time, I would probably still buy it. Now, if I lived in an area where rent is, way less than buying, I may reconsider it. But I live in an area where rental prices of a house similar to the one I live in is going to be $3,000 to $3,500 a month. I would rather buy and lock in my costs. And if interest rates do go lower, then I get to refinance and lower my costs. So I'd rather lock it in for a long period of time, but that's me. That's the way that I look at it. I look at a house as a way to lock in my costs, not as a way to make money. It's not an investment to me. When I was looking, it was all about locking in my costs. Here's Ted Zhang. He says, over time, I've learned that the current chart pattern is not enough to find yourself the best names. You must consider previous trading history, smoothness and linearity of trends, and ability to make big moves in short periods. You must consider whether there's a reason for the stock to make a big move, whether that is a theme, macro, fundamental, or earnings catalyst. You must consider share structure, market cap, float, existence of options, warrants, rights, etc. You must take a holistic approach to this. I completely agree with them. If you want to be really good, this is how you do it. I'll give you guys some information of how I do it and what I would do and what I've learned over the years. What I do is I sift through all the companies using chart patterns and the technicals. That's where I start. I don't want to buy something that looks technically crappy. So I sift through hundreds of charts or maybe even thousands of charts that I've looked at in history. I generally I've got a watch list of 10 or 20 companies per sector. I look at the charts. Boom, 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 boom. I scan across everything and I say, these are the ones that look the best. Then I dive into each of those companies. I don't want to buy just because the pattern looks good. I want to know that I'm buying value. I want to know that I'm buying it at a good time. I want to know that the chart looks good. So if the chart looks good, that's where I start. Then I dive in, I look at the sector. Is the sector good? And sometimes what I do is I look at the sector, make sure that the sector is cheap, then I go look at the charts of that sector, then I keep diving in. I generally listen to a few quarterly earnings calls, most likely the last two. I want to see what the insiders say and the CEO and CFO. I want to see what they think about the market and and I want to hear them talking about their business. I also look to see if their net income is going up and improving. So I go and I look at the fundamentals to some degree, but I also know that a lot of these companies and commodities, the fundamentals change rapidly. That's the reason we're there. So you kind of have to buy when the fundamentals look like crap. The technicals look good, and the commodity in the sector is cheap. And that's what I've learned. And your share structure can be good or bad. That really depends on the company. What you want is you want a company that doesn't want to dilute its shareholders. So looking at history, have they diluted shareholders? And what did they do with the money if they did dilute the shareholders? Sometimes it's okay to dilute shareholders when they buy another company that's making a bunch of money and is going to be very accretive to the bottom line. So I'm not in the camp that all dilution is horrible because it's not. If they are buying assets and increasing their value per share, so to speak, or production per share at a rate that is, at the same rate that they diluted. So I think this guy is completely right. I don't think you should do technical analysis only, and I don't think you should do fundamental analysis only, because then you don't know why or where it's inflecting. I think you need the three pillars that I created, um, which I use, which is ratios to tell what the value is, market conditions, which is when this inflection occurs. He calls it a catalyst for the stock to make a big move, a theme, a macro. That's your market conditions. That's the catalyst for it to move higher. And then technical analysis to basically make sure that the herd is lining it up. Yeah. Peter Lynch says the person that turns over the most rocks wins the game. That's always been my philosophy. So do a lot of research, see what's out there for investments. Person who does the most research in all those investments are the ones who win the game, so to speak. I would say that's partially right. The way that I do it is, again, I go technical analysis, and I look for companies that their charts look really solid. And then I start diving in and turning over the rocks. What I would do. The fastest way that I've found to do it. I don't do stock screens. I don't screen it through your brokerage account. I used to do that when I was a younger investor. It just doesn't work that well. Here is China. So China's real estate crisis looks nowhere near over. And this is the problem with demographics. This is what a deleveraging looks like. Price of both new and second-hand homes continue to fall in July, highlighting anemic demand. Chinese government efforts to stimulate investment and consumption are barely moving the needle so far. So this is the fall in Chinese home prices got worse in July, and they're going down, 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 down. Secondhand home prices fell record amount, dropped in all 70 surveyed cities, minus 8.2% here for secondhand housing, and then the average price of newly built housing. So existing homes and new homes. What's driving this is their demographic coming into home buying years. This is a problem. This causes deflation. And I don't know how they're going to turn it around. Japan was not successful turning it around because the demographic that went into home buying years was going down, not up, but down, but down. So they're going through the same kind of outlook as Japan, but they're getting impacted even worse in terms of how fast it's occurring. So coming down to Julianne, it says OPEC plus floating a test balloon in the crude oil markets. OPEC plus sources say likely to begin a production ramp up in October, and Brent is down 1.53%. So OPEC most likely is probably going to increase production. They're going to ramp it up in October. They most likely see more demand out there. They wouldn't ramp production for no reason and try to push the prices down. To me, this is actually bullish, not bearish, is the way that I view. Isabel Net for commodities, this person says, commodity bull markets have historically lasted for extended periods, often a decade or more, and have the potential to generate substantial returns for investors who maintain exposure throughout the cycle. So here's the commodities 10-year annualized return. So it started in the 60s and worked its way on up. And being early when commodities were cheap was not a bad thing when the ratio stayed down, but in the beginning of these moves, commodities and the overall stock market moved up together. Then the equities market, somewhere around this time, would roll over like it did in 1970. Commodities went way up and equities went sideways. And that's how they went up together during the commodity bull market in the 60s and all the way to 1980. I think that the bottom here occurred in 2016 and also 2020, which was a double bottom. This is a big double bottom. We've broken out of that bottom and we're consolidating here, moving sideways. But I think we've got a long way to go higher for commodities to go on up. You can also see last bull market from 2000 all the way up to 2008. We can also say that it began at this little spot in 1990, which was a slowdown in the market there. 1991 was. That was when the real estate market slowed down. We had a little overproduction, oversupply. But yeah, I think we've got a long way to go in commodities here. Long, long, long way to go. Here's crude oil. Warren Pye's opinion. He says HFCTAs are now net short gas oil futures by more than they've been outside of two periods, 2016 and 2023. In my opinion, oil is set up for a weak post-election period, but no big sell-off while positioning is extremely negative like this. So he doesn't think there's a big sell-off going on with the negativity that we've got in the oil and gas oil market. Now, I thought this was really interesting here. This is something I really want to talk about. So we've got Exxon and OPEC are warning of a looming oil crisis as global investments in new oil projects decline. The risk of a severe supply shortage and skyrocketing prices becomes more real. ExxonMobil predicts that without fresh investments, the world could face a 70 million barrel per day shortfall by 2030. Whoa, 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 whoa. Guys, does that make sense? 70 million barrel shortfall per day by 2030. We're 2024 right now, pretty close to 2025. Exxon and OPEC are signaling that the world could face a 70 million barrel per day shortfall by 2030. Now, there are some things that are quite alarming. The first thing that I showed in this thread was this is where the majority of oil comes from. It's coming from the lower 48 oil production here. This is where a lot of this growth came from 2016. You can see from 2016, we had all this growth in oil production. To me, this is a little bit scary. We could see this roll over here, guys. I don't know if it's going to roll over just yet, but if we see a rollover in shale, man, that's going to be huge because I don't know where this 70 million barrel per day production's coming from, guys. If this shortfall materializes, I mean, this is going to be like the best investment of anything. I know people talk about the shortfalls in uranium, but uranium is downstream. Everything is downstream from oil. Oil's like the basis of everything. It's the foundation that builds everything. So uranium is a byproduct of oil. It's it's uranium that is mined and crushed and done from all these different fossil fuels. So is copper production. So is the transportation of most everything. Same with the production of plastics and all these other things. Oil's the number one commodity in the world. If we get anything like a shortfall, I mean, 70 million barrels a day is ridiculous. Like that's just absolutely mind-blowingly ridiculous. And obviously new investments will have to offset that, but I just don't know where we're going to get 70 million barrels. I really don't. I mean that's seven OPECs or seven Saudi Arabia's. I mean. Saudi Arabia produces about 10 million barrels per day. We need 10. We need seven more of those to offset this decline that's coming by 2030. Every single year, the decline rate is about 10 million barrels per day. That means every single year we need to find a new Saudi Arabia worth of oil of production every year just to stay flat. Now, by 2030, I'm sure production will increase or demand will increase above where we're at today. So not only do we need a new Saudi Arabia every year, we need a Saudi Arabia plus the growth. So if we're going to like 110 million barrels or something, well, we need to grow it up to 110 million barrels. And we need to offset all the declines. And that's just where my mind goes ballistic. It's like, where's this going to come from? I don't know. I think this is one of the best investment opportunities out there. And given where the valuations are of these companies, this is just, it seems like to me, if you take a long-term mindset, it's a really good setup for investments. Just a really solid approach. Get some of these companies that have infrastructure in place. They're already producing. They're growing production. They've got a ton of reserves, 30 years, 40 years worth of reserves in the ground, it just seems like a really solid bet. So that's my opinion there. But that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We got the question and answer session that's occurring today, Saturday. And we'll catch you guys later. This is Finding Value.